and we will get into the presentation. Just before I introduce Brendan, I'm going to, for the benefit of those who are listening to me for the first time, just tell a little bit about MRD, who we are. MRD basically is here to give you the freedom to choose your future. Our goal is to give you the ability to build long-term wealth for yours and your family's security. As experts in building property investment portfolios, our approach is to treat your property investments like a business, but most importantly, our approach is to treat you like a partner. We'll teach you to invest the smart way with the least amount of risk possible and help you to learn the simple way so that you can grow the right way. At the end of the day, we're here to assist you. You can think of us like your personal assistant in property, helping, advising, researching for you, and looking out for you. We like to say, learn the simple way, invest the smart way, grow the right way, and property the confident way. There's a list of the services that we offer, and with respect to the financial planning side, tax and accounting, we're partnering with people such as Butler's Accountants and Brendan, and tonight you are in for a treat. He's got a wealth of knowledge, and I'm sure you're going to get a lot out of the session. So without any further ado, I'm going to hand over to you, Brendan, and you can take it away.
Good evening, everyone, and thank you for joining us tonight. Firstly, I would just like to thank Nick and his team for inviting myself to speak tonight. Look, I've got a lot of information and data to go through, so I'll apologise in advance by saying it's quite heavy and quite fast. But as Nick said, please put your questions in there. We'll do or endeavour at the end to answer as many or all of the questions as we can. But no questions silly. Haven't been stumped too many times, so often look forward to those questions to see if something is certainly outside the normal thought process. So I'll quickly and without any ado jump into the presentation. Firstly, I just draw your attention to the disclaimer. The first line really says it all. It is a general summary only. I would suggest for your own personal individual objectives, you speak to myself or Nick and his team at MRD. We're more than willing to give you any advice and help you make decisions as to what is the best for your personal circumstances. Okay, the SMSF overview is, and for a lot of you, or some of you, you've already got experience with SMSF or already have an understanding, but I'll just run through a quick overview of the actual life or length of life or objectives of just a self-managed superannuation fund on its own. Firstly, the question of how long will you have the fund? Again, it's a question of every individual. The easiest way that I define this is by saying, with a bit of luck, it will outlive you. So, for example, your members of the fund, up to 4 members, and I'll repeat that a number of times and give you some different strategies to bring members into the fund, but the members of the fund may very well be your children or great-grandchildren or grandchildren, which means that the fund and the fund assets may live on well beyond your life. Is it worth the effort? In my opinion, yes. I wouldn't be speaking to you tonight. Superannuation is a heavily subsidised government scheme or strategy to get people being self-funded in retirement and to avoid the government having to fund an ageing population. How does it start? The process of starting a self-managed super fund is the process of establishing a trust deed and a company. That process I'll detail a little bit further into the presentation, but initially no self-managed super fund really should be started without obtaining some proper advice to get an understanding by the advisor of your individual circumstances and the objectives and to whether you suitably qualify for a self-managed super fund and what you're aiming to achieve. When does it end? It's a little bit like I said before, with a little bit of luck, it may not end. It may last a very, very long time. If you've invested quite well, hopefully it will outlive you in terms of your investment requirements or living requirements in retirement, and may very well be part of your overall estate planning beyond your life. I think the most important point to highlight is that the tax benefits of a self-managed super fund. I think besides the fact that most of us have funds or monies or our own wealth accumulated in this industry or entity of superannuation, the tax advantage of it is massive. I had this with tax haven and constantly tell people, don't
Muted.
strategies to put assets into tax havens such as Vanuatu or Monaco, worry about providing for your retirement and getting into the superannuation environment where the normal tax rate in superannuation is 15%. The tax rate on capital gains, and that's providing that it meets the provision of capital gains concession, which is holding an asset for greater than 1 year, is 10%. And if you are over 55 years of age or post 60 years of age, it is more than likely that your circumstances will best lead to you having a 0% tax rate within the superannuation fund. So again, to be clear, if you are 60 years of age and in pension phase or in retirement phase, you don't need to be retired, you still can be working, and you make $100,000 profit on something, the tax would be zero. If you make $1 million profit on something, the tax would be zero. There are specific documentation that needs to be completed and specific rules about being in pension phase, but for most people, as I said, that have dates of birth before the 1st of July 1960, it's at this point in time a very, very good option to look at. The standard company tax rate, just as a comparative, is 30% versus superannuation rate of 15%. So if you were investing in a company structure, you make $100,000 profit, you'll pay $30,000 tax. If you make $100,000 profit in a superannuation fund, you'll pay $15,000 in tax. You've immediately increased your investment return by $15,000. That can range from being as much as a 20% increase in investment return to maybe as small as 2 or 3%, but obviously each percentage point is strengthening your portfolio. And again, personally comparing that to individual tax rates, if you're earning greater than $37,000, the tax rate on every dollar above $37,000 is 34%. And I think, as most people are aware, when you escalate up to the highest marginal tax bracket, you're losing 46.5 cents in every dollar. So obviously funds made in superannuation at 15% or 0% versus 46.5%, it dramatically increased your investment return. The costs of a self-managed super fund, and this slide's a little bit deceptive. I'm not going to go into the overall cost structure of establishment and ongoing, but to give a guide around the cost structure of self-managed super, you will find that most advisors will establish a corporate trustee and a trust deed for around about in today's market, $1,500 to $2,000. It was only 3 or 4 years ago that the cost of doing it was impossible for under $3,000 or $4,000. But luckily for you, the consumers, supply and demand has pushed that pricing down. You must have a trust deed, and the deed itself is a document that has many similarities as a normal estate or a will deed that has defined assets that will be contained within that fund and distributed to beneficiaries under certain conditions. Obviously in superannuation, the conditions of release I'll go through later on, but their retirement, death, similar types of things like that at the point when you can get access to your funds. I think most people realise that if you're 40 years of age and you just want your superannuation, it's impossible to get hold of. We only establish for our clients a trustee company as trustee for that self-managed super fund. The reason being is we're saving clients a headache later on down the track. If the life of the fund goes beyond the current members, or the current members change, or the current members get divorced, or they die, or whatever it might be, if you're individual trustees, it requires a change of all those assets. So if you own properties, you're going to find that you're going to be visiting a solicitor and paying different fees, whether it be conveyancing, possibly stamp duty and other fees to transfer the property. If you have a corporate trustee and the membership changes, the process is only as simple as changing the director or shareholder of the company. You're virtually talking about a $100 process, and all documentation is dealt with. How many members can you have in a super fund? I encourage people, depending on their circumstances, to have up to the maximum, which is 4 members. The 4 members do not need to be related. They can be friends, they can be next door neighbours. There are a few requirements and restrictions around employee-employer type membership, but the obvious benefit of having multiple members is you have more money within your fund to establish an overall investment strategy. The process or the systematic setup of a self-managed super fund is normally best done under advice. So if you are thinking about or requiring a self-managed super fund for all your purposes, I would suggest you initially should talk to an accountant who will qualify your needs and your needs analysis, give you a guide as to the costs and the costs involved, and will direct you in the right process. Most accountants now can establish a self-managed super fund, including the deed and the company, within a matter of days or to a week. We've streamlined our processes that most of the time, if you're talking to us at 9 o'clock in the morning and you can get all the required documentation back to us by 12 o'clock in the morning, you'll more than likely have that self-managed super fund set up by 5 o'clock in the afternoon. The advice will flow through in terms of after talking to the accountant as to whether you need further advice to establish bank accounts, to roll over or transfer the funds from your existing superannuation provider, industry or retail fund, an Oz Super, Plum Super, Colonial First State, Q Super, Sun Super, whatever they may be. There is a process of completing the correct documentation in the correct form and transferring those funds from that superannuation provider into your bank account that you control under the superannuation rules in your self-managed super fund. It's not an overly onerous or difficult process, but like all paperwork, when you're talking about 3 or 4 pages with difficult questions on there with regards to something you've just established, seeking the advice of a financial advisor to do that and implement an initial strategy is quite logical. What or why would you use a financial planner? As I said, it's not necessary. You can, under the guidance of an accountant, establish your self-managed super fund. Your accountant cannot give you any advice unless they're a licensed financial advisor with regards to establishing a bank account, which bank you should use or what you should do with your funds, or whether the property you're investing is suitable for you or whatever it might be. That advice must come from a financial planner under strict regulations and rules of ASIC. Your planner will help you develop an investment strategy, so what you'll be investing in and how you'll be using your funds. That is a requirement of ASIC under the law, or the Superannuation Industries Supervisory Act, that you must have a strategy in place. Your planner will obviously help you establish a bank account, which is not an overly difficult process, but will often know the best funds or best bank accounts that are suited towards self-managed superannuation environment. They will obviously assist you and complete the paperwork of transferring from your existing superannuation provider into your self-managed super fund, what's called the rollover process. Interestingly enough, in the last probably 3 or 4 years, what the process of even going onto a website and just attaining those forms was pretty stock standard. We deal with many clients and probably involved in this rollover process at least half a dozen times a week, and it has become overbearingly difficult to obtain those forms from the superannuation funds existing. Of course, if you contact them and harass them, they'll email them out to you, but you can find that alone will take up to 2 or 3 days before you may see that documentation, sometimes even longer. The most important point, I think, with a financial planner is insurance. I've often stated and always do state I don't want to be faced with a situation where someone has rolled their funds out of an existing superannuation fund into their self-managed super fund and not considered insurance. And what I mean by that is most of you, or some of you that are in industry funds, will have ticked boxes or options at certain times to take up the insurances within that superannuation fund, whether it be life or income protection or similar types of insurance. Often a lot of those insurances are not well thought out or not well strategized. They often appear very cheap because they've got limited coverage, but needless to say, life insurance is pretty quite simple. If you die, you get paid. If you tend or you roll out of a existing superannuation fund into your self-managed super fund, and you have not established new insurance or left a balance in your existing superannuation fund until new insurance has been established, you're effectively uninsured. Any financial planner that is familiar with the process of rolling funds from a self-managed superannuation fund will normally handle this process very well for you and make sure that a review is done of your existing insurances, and obviously find you better or as good as comparative insurances. In our situation, if we can't find as good an insurance, then we may recommend a strategy of leaving a minimum balance to cover your insurance within your existing superannuation fund. Lastly, the planner should, and any good planner should, have a very, very good understanding around the tax strategy and the ability to contribute or recontribute or boost your contributions to give you tax advantage in the process. Often with clients that we have that are post 55 years of age and working, they're often bewildered that no one's ever told them that they can simply just have a process of taking money out of their superannuation fund and putting it back in and immediately receiving tax advantage of up to $3, $5, sometimes even $10,000 per year each and every year. So those that are younger than 55 years of age, there is still very, very good strategy to be developed in terms of what you're trying to achieve in your fund and what funds are required, or what the liquidity, and I'll use that terminology quite a bit, liquidity being the funds required in your super fund to achieve your objectives. This is a very good point that I like to stop at this point in time and just make anyone that I speak to about self-managed superannuation very, very aware of what really is a very simplistic rule, but it is the rule of the ATO and the Superannuation Industry Supervisory Act, or SIS Act, that says your fund needs to be maintained for the sole purpose of providing for retirement benefits to your members or their dependents, or if a member dies before retirement. So really what that's saying is, if you want to set up a self-managed super fund where you have purposes beyond providing for your retirement, then chances are you're probably doing the wrong thing. The days are gone where in the early days people would go and buy a 40-foot boat in their self-managed super fund and use it for private parties or staff parties or whatever it might be, and often they would say, well, I'm using it for a staff party, so therefore it's really a good asset to be used and we're paying rent and all the rest. That would breach the sole purpose test. Your sole purpose has to be to buy the asset to provide for your retirement. If you bought the asset, being the 40-foot boat, to provide for entertaining your staff or to use occasionally or whatever it might be, you'll basically be breaching that. Does it mean you can't buy a boat? No, you can buy a boat. It would need to meet certain collectible rules. We would need to prove that it's a valid investment, and you'd have to live with that you're probably never going to see it or use it. It would have to be stored either in a secure site that is for such investments or within a museum. For example, if you happen to find the boat that existed for Moby Dick, if it ever existed, chances are that's probably going to fit into the rules of the investment, but you certainly won't be able to get any personal use out of it, and it certainly won't be stored at any premises that relate to you. Your SMSF responsibility. I'll just bring these up on screen quite quickly. Your responsibility is to make sure that it's structured correctly from the beginning and ongoing. That responsibility in terms of structure is fundamentally why you need and must have accountants involved in the process. The laws, although for the last 3 or 4 years have been quite stable, have tended to move quite a bit within the self-managed superannuation arena. I don't know of too many non-accountant or non-trained people that can afford the time to stay well adept in the Tax Act and the SIS Act. And really, my advice would be that talking to any accountant around self-managed superannuation fund, I'd be digging quite deep to see how many funds they have or what sort of involvement they have. In my opinion, if it's not part of your daily job as an accountant to deal with superannuation matters, you're probably out of depth. Your responsibility around reporting to members and providing information to the members, again, that documentation is prepared in the process typically by your accountants, and a good accountant will educate you on particular needs in terms of minutes and other documentation that may be required around the members of the fund. The trustee, so being the trustee responsibilities, which is the same as the members but in different role. As a trustee, it is you who is legally responsible for the assets that are being held, and legally responsible for making sure that they're adequately insured, they're adequately maintained, all of those different things for the members, whether it be the members that are there now, whether that member, if you had 4 members, whether one member has $10 in it and one member has $150,000 in the fund, all members really deserve the same rights by the trustees to make sure that the assets are looked after and dealt with properly. And you need to also be assured that your contributions within the fund are being properly recorded and timely recorded from employers or other sources of where those funds are coming into the self-managed super fund. And finally, I suppose to top it off and to really emphasise the process of the need of the accountant in it, you have to have tax returns and financial accounts completed every year. So just to define the difference, financial accounts are your typical profit and loss scenario. Within a self-managed super fund or any superannuation fund, they have a statutory form they have to follow, so they're a little bit different to people's companies and trusts in terms of form that they need to follow. They obviously need to account for every single member separately. So the assets on the cash or the investments, the shares, the whatever it may be, is held as a group, conglomerate, and bunched together. So it's possible for a self-managed super fund, for example, to have 4 members with 4 different balances, but have just one property, let's say, worth $1 million. Each member owns a different proportion depending on their membership balance. So they get a different proportionate share of income from it, and they pay a different proportionate level of tax. So if you had someone that was 60 years of age at a 0% tax rate, and you had your son or daughter in the fund that was 35 years of age, the tax on the earnings to the 60-year-old would be 0 tax, and the tax on the earnings to the 35-year-old would be 15% tax or possibly 10% tax. They all have to be accounted for, and those members' balances need to be calculated and kept separately. The tax returns are completed off the financials by the accountant, and then finally the financials go off to an independent auditor for us to give a good indication. We have a couple of independent auditors that we use, but the majority of our super funds go off to Deloitte's, the multinational accounting firm, to audit those funds. In that process, they are really just checking that the legislation has been complied with, that we as accountants have prepared the fund in the correct format, and to make comment or to notify the ATO as to whether there's anything that doesn't fit the normal requirements or doesn't meet the rules and regulations around superannuation. If you contravene those rules, it is called a contravention report. It's not the end of the world. We deal with at least a handful of those each year, and as long as they're not of epic proportion, then typically the ATO's approach is very, very approachable to those genuine mistakes. Simply, and I'll push the point of the accountant again, good accountant, make sure they're an SMSF expert. I would suggest, an accountant as a minimum, or a segment of an accounting practice needs to be dealing with at least 100 self-managed super funds to have a good spectrum of all levels of advice day in, day out. The biggest question, and then the most common question that I'm asked, when I first talk to any client over the phone, face-to-face, or whatever it might be, the phone's a really good example because you can't see how old someone is and you don't get a perspective of it, is I'm generally asking them how old are they, how much do they earn, are they currently employed, that type of little bit of a fact find. But of course the big question is, how much do you currently have in superannuation? The media or the typical industry will tell you that the magic figure is about $200,000. That $200,000 being derived from the industry funds are charging a fee of around about 1%, which is $2,000, and that generally matches the fees that will cost for your financials and tax returns to be prepared each year. I use the word generally, like I've used generally more than $150,000, because it is all very general. Everyone is very different, and everyone has a different perspective. I will highlight that really clients looking to go into a property purchasing strategy through borrowing, through superannuation, it becomes very, very difficult if the sum is less than $100,000, but it doesn't mean that there isn't a strategy to accumulate those funds or contribute to those funds. Either myself or especially the team at MRD can help you develop a strategy to build your superannuation that can lead you towards your objective of buying property if that's your overall objective. I've had clients that have had $10,000 or $15,000 in superannuation, and I've gone, you shouldn't set up, it's not cost effective. They've invested in something that, of course, as a financial planner, I can never advise them they should invest in, and they've made their money 10 times more, so the $15,000's become $150,000 in a 12-month period. Did they make the right decision? Of course. So I say generally, and I say the media is selling to the masses. Superannuation is very individual. A good advisor will tell you whether your overall perspective of what you've got and what you're wanting to do will fit into not the requirements, but the general objectives being possible as to what you want to achieve in your superannuation. Accessing the fund, again, I'll just bring most of these up quickly. Accessing the fund means really, when do you get your money? So how do you get access to the years of hard work that you've put into building a retirement strategy? And I use retirement strategy. The first point there is very, very simple. You can't access your funds generally until you retire. For most people, that starts in process, or it's possible to start in process at age 55. It is unconditional at age 65. So in other words, you have access. I suppose to give a good clarity around that, people say, well, we talk about when we enter into pension mode. And to be clear, the pension mode in superannuation is different to the pension provided by the government under Centrelink benefits. Pension mode in super is just a terminology that's used that says you're now in the process of drawing funds from your superannuation fund. That pension can be drawn daily, weekly, once a year. It just has a minimum requirement that must be drawn each year out of the super fund. For those that are over 60 years of age, that starts at a 4% of balance and then escalates up as you get older, but gives the massive advantage of being in that pension or retirement mode and being able to access your funds, that the superannuation fund is taxed in a 0% environment. If your balance is under $200,000, I should say, not $200,000, you can access and take your money out of superannuation. If you're facing financial hardship, and I suppose to be clear, that really is a definite bankruptcy situation, and you're under 60 years of age, it is possible to access your superannuation. I would really suggest that you seek good advice around that. Superannuation is protected under the bankruptcy laws, so it doesn't go into a bankruptcy estate. So it's normally my advice, don't draw on your bankruptcy, or don't draw on your superannuation to fund a bankruptcy, because you'll never get it back. The compassionate grounds, in terms of that, you've got a child who's got cancer or similar, may get you some temporary relief out of superannuation, but very difficult. If you're a non-resident leaving Australia, if you have a permanent or temporary incapacity, a permanent disability, the terminology around that and accessing out of superannuation as per the law is very, very similar to the terminology that most of you will be used to under insurance, the total and permanent disability. Simply, if you meet the total and permanent disability rules as per the insurance funds that you've insured for, you probably more than likely meet the definition within superannuation to access funds. Death is obvious. Your funds must be transferred in a timely manner out of the superannuation fund to your nominated beneficiary, or if not, under certain controls by the trustee of the superannuation fund, to direct it towards your estate if that's the way your fund is established. Transition to retirement, so that's for people aged 55 years of age or older. They can access the superannuation in a small increment of a way, but it gives a benefit for planners like myself to enter into a very good recontribution strategy that's drawing some money out of superannuation and putting it back into superannuation, effectively drawing money out and having a minimal tax consequence on it and putting the money back in and receiving a tax deduction for it. And if you cease employment after 60 years of age, again, you can have full access to your superannuation fund. The big question that's asked by a lot of people, and I often get this in question times when I'm presenting in any way, is I have a brother or an auntie or an uncle or a sister or a brother's auntie's uncle's sister or someone remotely related to me that has a property that I want to buy. My simple answer is, and I don't like to say anything is impossible, but just don't do it. It attracts very much unwanted attention from the ATO. It will absolutely escalate your costs through the audit process in terms of the auditor being wary about it. It is virtually impossible to buy anything from related parties being relatives of some level. Adding to the self-managed super fund, so in other words, trying to build your wealth creation strategy is quite simple. Use your employer. They've got super guarantee that they're required to pay on your salary, so getting it directed towards your self-managed super fund is obvious to building the wealth and the growth of it. You yourself personally can and may, and is a very good idea under the right strategy, to make voluntary contributions into the superannuation fund, sometimes tax deductible, sometimes not tax deductible. Again, it needs to be assessed by the individual and the advisor. Rollovers, transfer in from another superannuation fund. You can lend to the fund. I'm not going to go into it very in depth tonight, but I will give a very quick overview soon about borrowing in a superannuation fund to purchase property, what's called a limited recourse borrowing arrangement. Obviously, when you borrow, most of you will be thinking, well, you borrow from a bank. It is absolutely possible to borrow from someone else, or for the super fund to borrow from you as the lender. You could do that by having excess funds in your own personal name. It may be possible that you've got equity in your own personal properties that you wish to boost into the superannuation fund and get repaid for. So very effective strategy. We do it, when I say quite often, we've got a couple of hundred self-managed super funds. We've probably got 20 or 30 that have this strategy in place. Just make money in the fund. Simply, it's really straightforward. If your intention, like the sole purpose test, is to build for your retirement, make sure you're investing in things that will be of long-term financial benefit to you and your fund. And again, I emphasise that you can have up to 4 members. You can have 1, 2, or 3, but if you find some friends and booster your self-managed super fund, it obviously develops a much wider strategy and a much wider investment possibility. My favourite slide, I could talk about this for probably an hour on its own, but quite simply, the industry funds or the retail funds have hidden costs. Now, it doesn't mean that they're all bad and they don't give you good investment return. Typically, what you see as your investment return in an industry fund, whether it be 1%, 2%, or 10%, is the profit share after a lot of costs. So the profit share to you, the member, after salaries to the employees, the rent on the Pitt Street building, the corporate box at the AFL, the sponsoring of the soccer team, the football team, and the relentless TV advertising to attract new members into the fund. I suppose my point on my slide, like the iceberg, is you as the member see what your return was and the administrative fees that they take out, but you're not seeing all those not transparent costs that are in the profit and loss of that actual industry fund, well and truly above the line where you start to see what the actual return was. It doesn't, as I said, make them good or bad. It just gives a level of non-transparency, as well as the predominant reason, and I'll emphasise this in a few minutes, of going from a industry or a retail fund to a self-managed super fund is flexibility. It's impossible, or virtually impossible, for you in a retail or industry fund to go, I want Telstra shares. It is definitely impossible if you go, I want to purchase this type of property in this location. The inflexibility is, I suppose, flipped upside down with the amount of flexibility that you have in self-managed super funds. So the benefits, like I just mentioned, is the flexibility, the estate planning, so the ability for you to bring your members in and out and control and manage the longevity of the funds that you've got within the self-managed super fund. The control, which I think goes hand in hand with the flexibility. You control the cost that you have within that self-managed super fund. If you think your accountant or financial planner is charging you too much, find someone else. You definitely are not going to be running TV ads to find new members. You're definitely not, well, I shouldn't say definitely, not more than likely you will not be buying a property to rent to run your self-managed super fund out of in Pitt Street. Totally not impossible, but highly unlikely. Your overall investments and your strategies are underneath your control, managed by you. I think that couples very, very well with the main purpose that I normally seek when I'm talking to clients to find that the reason they want self-managed super fund is the control aspect, that they feel they've got a better opportunity to make better investment decisions than what they've been getting. Obviously, the transparency of knowing what they're investing in, but the transparency to me is the big point. I don't have any doubt that when someone can see how much money's in their bank account, what portfolio of property shares or whatever they've got, the motivation towards putting more in to something that they can see immediate benefit to just tends to accumulate up. It just seems to be much easier for me as an advisor to talk to people about making further contributions into a self-managed super fund when versus goes into a retail or industry fund, and I'm continually fought with, well, I don't know where those funds are going. So the obvious benefits are those. There are a number of other benefits that stem off each of those things, but I think most people at this point, when they're learning or talking about superannuation, understand the control, flexibility, and the transparency of your self-managed super fund are the major benefits, versus the downside that you've got to take a further and instigated interest into the management control of your funds within superannuation. Look, beware, and beware is it's not all rosy, but it should be. If you have good advisors and you have the right purposes or right intention under the sole purpose test, then more than likely none of these things will ever come into play. If you don't comply with the rules or you break the rules, the costs are that the ATO will tax you at 46.5% of the gross assets. So what that means, if you have $1 million in superannuation, they'll tax you $465,000. Have I seen that happen over 20 plus years of dealing with superannuation? Yes, I've seen it happen a couple of times. But they were gross breaking of the rules in terms of someone rolling their $200,000 over and immediately taking it out to pay off their home, or similar situations that most people obviously know you can't do. But simply, if you've got an advisor in place, being a good accountant or a good financial planner, before all investments, my advice is just talk to them, ask them what you're going to do and whether you can or can't do that. For anyone that's trained in the superannuation industry, the question by a client honestly is a one-line email response or a very, very quick phone call away. You can lose the tax-free status of your superannuation fund. The ATO will always charge you interest on funds that are incorrectly taken. The last line is very important, and we do deal with at least half a dozen clients every year that have a fix-it clause, and that's when the auditor says there's a contravention because they paid the rates to the wrong property out of the superannuation fund, or they accidentally put money in and then put money back out to fix something up, just an internet bank transfer that they've done out of the wrong account and not realised it. Typically of small proportion. I think when most people transfer $100,000 or $200,000, they're going to realise quite quickly they've done the wrong thing. But most of the time, the ATO's response will be fix it, make sure your accountant and your auditor sign off on it next year. The auditor will note in the next year that there's no contravention. The ATO is more than satisfied with that process. It's not a catch out, yes, I'll do this, and they'll just say it's okay. It's just been my experience that the ATO doesn't want to, and the government doesn't want to eat into your retirement savings. Their strategy is to encourage and help you build what might be their burden on funding retirement. The major reasons for breaches are late lodgement, not lodging your tax returns and your financials in time, early release of funds, so in other words, taking monies out before any of those release conditions, retirement, death, etc., lending to other members or lending to family and friends. Again, just don't do it. It's not even worth considering. And we have this very rarely because good advisors and good people like MRD and Nick and his team, they'll ring us and say what title should be, what should go on the contract, what name goes on the contract to purchase this property, what is the correct title that should be going on the property with the purchase that's going on at that point in time. To probably summarise or give you a very simple slide on borrowing in a self-managed super fund, you have your self-managed super fund there on the right-hand side. You have a bank or a lender. The lender, as I said, doesn't necessarily need to be a bank, but it's pretty simple to understand. It will lend to the self-managed super fund. The interest will be paid by the self-managed super fund. The rent will go into the self-managed super fund, or the interest or the dividends. The costs will be paid for all out of the self-managed super fund. There is no need to establish any other new bank accounts or do anything else. But the law requires that it's done under a limited recourse borrowing arrangement. And without getting too technical, the next slide is by far more technical, and I think this is a good introductory to bring you into a more difficult slide. You must have a custodian. We just have there a custodian proprietary limited. That's a very simple way of looking at it. You must have a separate company that's as trustee for a trust, which 100% of that trust is owned by the self-managed super fund. So in other words, the asset is bought in a separate entity that the only beneficiary of that other entity is the self-managed super fund. It really means that the borrowing arrangement is happening for an asset that's not owned by the super fund, but owned by another one of your entities that is allowed under the law to go through the superannuation process of borrowing. In this next, sorry, it's the next slide after this one. Why borrow? I mean, I think most of you will understand that if you've been involved with borrowing before, you're leveraging for higher returns. It does come with the risk of higher losses, but depending on your personal circumstances and what you're looking to achieve, and if it's well managed and well balanced, obviously debt can be a very good friend in increasing your returns. When you borrow, it must be for a single asset. So in other words, you can't borrow a certain amount to buy 5 or 6 properties. Each investment that you are borrowing for must only be for that singular asset. You need to consider as a trustee and probably in consultation with your advisor whether the fund has adequate liquidity, cash flow to manage the property or properties or investments that you're borrowing for to purchase. And finally, there are very, very good tax advantages both within the fund and externally by a contribution strategy by borrowing in your superannuation fund. That being said, I don't emphasise tax advantage as a major advantage in a self-managed superannuation or a superannuation environment because it's a very low tax environment. 15%, 10%, 0%, they are as high as the rates will be. So in other words, $10,000 worth of interest deduction in your own personal name may result in a tax refund of up to $4,600 or slightly more. It will never be more than $1,500 of lesser tax in a superannuation fund. So this is a slide I was talking about that's a little bit more complicated. The green at the top is your self-managed super fund. That self-managed super fund is obviously yours. You then deal with a lender, whether it being the bank or a friend. Typically there'll be a guarantee to that lender. The mortgage itself it does go back and forth with the superannuation fund, but it's mortgaged on the asset that you are buying, the separate property. That separate property is purchased by a holding trust. So this separate trust or custodian is a proprietary limited company that has a separate, what's called a holding trust, bare trust, and there's a lot of terminology used, but simply that trust is bare to the extent that it only owns the property for the benefit of the self-managed super fund. It's an interesting element of the law, and I don't have time to go into it tonight. The way this came about was on the back end of the Telstra 2 float back in the 2000s. It provided an opportunity, I suppose, for accountants to jump on board and go, we can now borrow in self-managed superannuation. And I was one of these people that have been around that hadn't been allowed since 1999, and probably in my age group and not being able to borrow at that point in time always wanted to. So it just opened up a good perspective to allow it for people to increase their returns and leverage through superannuation. How it works, and I'm going to repeat this a couple of times, and I already have, good advisors. Make sure you have people around you that have SMSF experience. Make sure you have people around you that have your overall wealth creation strategy at heart. Make sure that you understand the costs involved. Make sure you have the funds available to establish and proceed with what your strategy is and what you're trying to achieve. And I suppose once you've hopefully gone through a process like this and talked to a good advisor, the last question is to make sure is it for you? Do you fit the model of wanting to control and have the transparency and flexibility, as well as a little bit more of a burden on paperwork to what you possibly have at the moment? But again, with a good advisor in place, that process is by far simpler than people envisage it to be. I'll, at this point in time, just hand back over to Nick. And again, thank you all for listening, and thank Nick for inviting me. We'll proceed with the questions after Nick's just had a quick brief chat to you.
Well, thanks, Brendan. That was fantastic. Let me just see. Your little sidebar is where you type your questions. And don't go too far, Brendan, because I'm going to swing straight back to you. First question is, how long will SMSFs be heavily subsidised given the current climate, and talk with the government to remove the subsidies?
Yeah, that's a great question. I mean, I love that question, and the question is how long? I don't know. I do know this. It is absolutely not in the government's interest, where they're trying to get people to self-fund for their retirement, to not have superannuation as a heavily tax subsidised alternative. If it's not heavily tax subsidised, there has to be something else that the government has to do to encourage you and I to put money into superannuation. Obviously, if there's the easy target, I suppose, is to use accountants, and if accountants are promoting and saying that self-managed super funds or superannuation is great for a tax strategy, then people will follow that. I have been saying since 2007, since we've had this tax haven environment, it's too good to be true. I don't think a 0% tax rate will last forever. I have clients that have made $1 million a year over 4 or 5 years and not paid any tax. It's a fact. But then again, you know, during the process of trying to get people to accumulate into superannuation, there has to be some sort of benefit. So it's a great question. I don't have the answer, but I really believe that the government can't walk away from that thought process of subsidising people to invest for their future retirement. The next question is, how does a bank consider your mortgage to an SMSF against mortgage outside of it from a borrowing capacity point of view? Again, that's an awesome question. So you'll hear this terminology, LRBA, limited recourse borrowing arrangement. Limited recourse borrowing arrangement means that the bank has a limited recourse. So the bank cannot use anything else for security, and the bank cannot rely on that other security to pay the mortgage on the self-managed super fund should something go wrong. So should we have a catastrophic property crash, or you know, there's been some sort of overcommitment by the borrower within the superannuation to meet their needs. I would say it's unusual that someone can't meet their cash flow needs of borrowing in a self-managed super fund, because a bank will require at least that 20% equity. And someone like MRD will produce cash flows for you, or good advisors like MRD will produce cash flows for you to show what your overall cost structure is going to be. So I suppose I'm trying to hopefully answer that question for you by saying it's ignored. The bank doesn't care about with your own personal situation in terms of borrowing. They care about how much funds you've got in the superannuation fund, whether you've got sufficient deposit to make that property stand alone, and whether you've got some regular contributions going into the superannuation fund. To be honest, as the accountant, I see a lot of it. I don't deal with doing the deal making of it. Certainly the team in MRD can give you really good direction on that. Here's the question that there's questions are flying in at the moment, so just if I stutter a bit, that's because I'm getting multiple ones at the same time. Besides property, what other investments you see for SMSFs? I think the question is, what else can you invest in, or what else have I seen? I love telling people this story. I have a client with a prehistoric shark tooth. I have a client of a photograph signed by Muhammad Ali fighting Joe Frazier, taken by Frank Sinatra. The rules around the investment is it just has to be a valid investment. I really encourage people not to get carried away with the shark tooth and the photographs and so forth. You will never enjoy the benefit of it. It must be secured, locked away, insured. It's not for your benefit. But, you know, there are bottles of Grange, there are different things, shares, property, warrants, cash, all levels, gold, silver, all levels of investments. Timber, I have a client that's invested in timber. I've seen all different types of investments. I think it's a little bit like follow the strategy that's individual to your needs. Certainly if you've got a particular skill, so you understand wine or timber or whatever it might be, I wouldn't discourage it as an accountant and a financial planner. I definitely can't go on paper saying I'm recommending it, but the question is a good question, and I love that question because the answer is you can just about invest in anything as long as you're not buying off someone related to you. The next question is, what are the ongoing fees to have an SMSF? Accounting fees, auditor fees, and other fees. Difficult question. We base our fee scale on the number of transactions, so the number of investments. We don't care if a client's got, you know, $100,000 or $10 million. If it's $10 million sitting in a term deposit, more than likely it's going to cost probably somewhere in the vicinity of around about $2,000 a year, including audit. If it's $100,000 staggered across 40 different investments that are traded every week, it's probably going to cost $3,500. So the question is, it's very individual, but if I gave you a range, certainly within our client base, we don't have any fees less than $1,000 a year. You can't even pick up a self-managed super fund and go through the compliance ticking for that sort of level. And we have obviously some very massive and wealthy clients. I think the largest one might be about $6,000 a year in fees, and it is a fund, into the multi-millions. Other fees is the question. The other fees is up to you. It's a little bit like I said, you've got the control as to what you're doing. If you manage and do all your investments yourself, then you really will have no other fees in that process. If you use advisors or other types of strategies that you require people to help you with, then of course there's going to be fees around the self-managed superannuation. Good question here from a person, which is, what is the LVR when borrowing from a bank for a self-managed super fund? From my perspective, look, I'm not live with that data day in. The guys at MRD will definitely be live with that data. I talk to banks often. I see deals being done daily to weekly. As a general rule, it will depend on the bank. There will definitely be no one that I know of that will fund with less than a 80% LVR, so in other words, a 20% deposit. If you've got 30%, look, in all honesty, you're pretty safe to make sure that you can buy a residential property. Commercial property has higher LVRs, just like normal lending.
At the moment, a lot of lenders won't lend for SMSFs. There are lenders who will lend 70% LVR and provide an offset account. These are major banks. Others will lend 80% LVR but won't give an offset account. We have found a lender recently that will do 80% with an offset, which is very rare in this day and age, but generally 70 to 80%.
The questions keep coming in, so I'll try and keep the answers as brief as possible, but looking at these questions in advance, this is a more intelligent crowd than the earlier crowd tonight. They're very good questions. Nothing's got me stumped so far, but they're just another level up, which is great. The question is can an SMSF invest overseas, property, for example? The answer is an absolute yes. We have more than a handful of clients that do have overseas properties. We have a number of clients that took advantage during the GFC of purchasing in Texas and different places like that within America to buy properties. Look, it can be done. Your fees are going to be more. It's more difficult for an accountant to understand. It's more difficult for an auditor to understand. For example, in America, the process of purchasing a property, they have different structural requirements as to what we have, and proving the beneficial ownership goes to the superannuation fund can be a little bit more difficult. But look, you can definitely invest overseas, whether it be property, shares, or whatever. Investments are investments as long as they're valid. Next question is, what determines shares within an SMSF for multiple members? A lot of math. The software, thank God, is the easy way to put it. The math is around the different, obviously, values that you bring in, the different earnings that are applicable to the members, the different tax rate applicable to the members, not contributions, the withdrawal benefits that a member can take and one member chooses to take over another. The software that we use, I mean, there's a couple of big ones, but the accounting software, BGL, has a very, very good back-end actuarial certificate to make sure that it's proportionally done the right way on a daily basis. So, for example, if the questioner here had $100,000 in a self-managed super fund and I had $200,000, it doesn't necessarily mean that I'm going to get 2/3 and you're going to get 1/3. It is going to be based upon whether we put more contributions in and what that daily balance is, versus whether I'm in retirement age and maybe taxed at a different rate to what you are. But generally, it's a very complicated mathematical process that once upon a time we did on Excel spreadsheets, and that's probably why self-managed super funds were $5,000 or $6,000 to do 10 years ago, versus good software making that by far easier. The same question, question there's come as in with a percentage of ownership. So there's not a percentage of ownership. It's really a moving depending on the moving balances. What do you recommend as the amount of cash on hand in an SMSF at any time, percentage of assets or set amount? Great question. I really, it's a general question that I can't answer. It will depend on the individual. Obviously, someone in retirement and drawing on the super fund requires a hell of a lot more in cash than someone in their 30s or 40s or whatever trying to accumulate into superannuation. I think the easy answer to how much cash is in the superannuation fund is probably why you get a financial planner involved. to make sure that you're optimising using your funds being invested without starving the fund off cash in the process. It's a little bit of cash flow management to develop that out. But generally, that can vary. I had a lot of clients, smart clients, that in 2007, 2008, pulled out of all investments and put money into cash. Smart move. They were funded at that point in time 80, 90, even 100% in pure cash. So there's no set percentage or rules around that, but it is particular to the individual and of course their feelings about the investment environment overall.
Good questions. Look at this next one.
These questions are great, right, coming in. Does a member need to complete an SMSF tax return each year, or is it just one tax return for the fund? Interesting question, right? If a member in their own right, obviously as a taxpayer, they have to complete a tax return just like you normally do. If a member is receiving benefits from the superannuation fund and they're in retirement over 60 years of age, and that is the only income they have, whether it be $10,000 a year, $100,000 a year, or $1 million a year, so I'll just emphasise, if they are in retirement over 60 years of age, there is no need to complete a tax return. So if you were making $1 million in your super fund, drawing $1 million out of your super fund, under the current legislation, you don't need to do one. If you're basically, if the question is more general in terms of do you have a super fund tax return and then you have a separate member tax return, no. There's one overall tax return to deal with the super fund and its earnings and what's going on. All your member details are separately and proportionately broken up and shown in the tax return, so the ATO is very aware of what's going on, but it's not itself a separate tax return. It's a separate schedule that goes within the SMSF tax return. So it's a great question. I've got a question here that was emailed through earlier, and that question is, can you borrow against the equity to purchase other properties within the fund? The answer to that question is no. No, you can't. A little bit like when I say no, you can't straight out, I say to everyone when I talk to them, look, nothing's impossible, and the question's a little bit broad. Borrowing against the equity of other properties in the super fund to purchase another property is impossible. Of course, you can sell the property and realise the equity and reinvest and do those things. Can you use equity in property that you've had outside of super and redraw on that and contribute or lend to your super fund to buy more properties in the super fund? Definitely can. But the laws around limited recourse borrowing arrangements prohibit you from drawing against the equity in the super fund to buy other properties. It's not. Look, I'm not all against that. I think it's probably good. I think it certainly details one thing as an accountant that you always try to do to go make sure the bank doesn't own you in every perspective and every way. It certainly means that the bank can only lend to you specific on that property and cannot cross-collateralise with any other property anywhere else. The second question is, when you sell a property within a self-managed super fund, is there capital gains tax payable? Again, possibly 0%, 10%, or 15%. If you're selling a property and you're in the accumulation phase, so not the pension phase, and you sell it within 12 months, then the tax will be 15%. If you've held it for longer than 12 months, the tax will be 10%. If you're over 60 years of age or over 55 years of age and in a pension phase, the tax, like I said, is a tax haven and it's 0% tax-free. Again, each individual can strategise the right way to do that, and seeking good advice as to whether you should raise or realise a property for capital gains tax is very strategic in the life of the fund.
Just before we go to the next question, I just want to draw your attention to the poll. If you haven't completed the poll, I'd like you to do that, and I'll show the results in just a moment. It'll be a percentage of who chose which answer. There is also a handout there, SMSF and property fact sheet, that you can download. That's all available in the toolbar. And we do have another question, Brendan. What happens if there's a fallout between members? Can you sell the assets and cancel the SMSF? How is this normally done?
It's another great question. I see it quite often. It's called divorce. And typically what will happen is, if there's a fallout between members, just typically what will happen is, like all commercial arrangements, which divorce is a commercial arrangement, you'll come to some sort of agreement between the two members that one person will leave. Yes, you'll need to sell down, so you've got cash to pay that member benefit out to another, to roll it out, transfer it out, just like the normal rollover that you would do to roll the funds in, and one member can stay within the fund. If neither of you want to stay in that fund because of whatever reason, bad taste, maybe under advice from your accountant because there might be some legacy in the fund that's not making it viable, you can certainly just roll both members out to a new self-managed super fund each, or superannuation back to an industry or retail fund. The simple rule is around a self-managed super fund, when there is a zero bank account balance, there's no members, self-managed super fund does cease to exist. So it actually can't be brought back to life once that happens. So it's a good question. The answer is yes, and how is it normally done depends upon the arrangement between the members.
Oh, I know. I think I might not have. I think I failed to launch the poll. Here we go. The poll is there, but I didn't launch it. Sorry, guys, but thank you for drawing my attention to that. So the poll is now open. That's the poll, not the pool.
There's a really good question there while we're waiting for the poll. Actually, this is a question that I've not been asked that often, and I'm not stumped by it. It's just a good question. The question is, would there be an age beyond which the setting of a self-managed super fund becomes counterproductive? The counterproductive is a pretty wide word, but just to generally say, is there an age where I would suggest to someone that it's not of benefit to set up a self-managed super fund? The answer is no. Again, it's up to the individual. If you were 85 years of age and on your deathbed and you had $2 million or $3 million in superannuation, I can certainly think of 2 or 3 strategies that you may want to roll out of an industry or retail fund into a self-managed super fund to achieve as part of your estate planning. But simply, like I said at the beginning, the life of a superannuation fund is hopefully perpetuous. So in other words, it will go beyond your life and into your estate planning. But typically, look, most people become most productive rather than counterproductive in terms of their superannuation requirements into their late 40s and 50s, and often that's a 20 or 30 year time frame. I mean, to really, I suppose, put the icing on the cake on that question in terms of the age and the life of a self-managed super fund, we've been doing it and been around as a practice for 35 years. We've had superannuation funds for 30 years. I'm pretty certain we'll have them around for the next 30 plus years, which will probably take me well and truly into my retirement. If we establish a good relationship of working with our clients and doing that, then the life and age of self-managed super funds goes, a long way beyond. I certainly have not many, but at least a couple of clients each year that pass away, and we have to deal with the death benefits within superannuation. They're around for a long time. So the easy answer is there probably is a situation where it's counterproductive to set one up when someone's of an age well beyond, being able to contribute to superannuation, but I can't think of a time or when that would be the case. Here's a question I get asked all the time. Can you purchase an established business through your SMSF? Okay, I'll put a big disclaimer on this one and I'll say yes, you can, but the structure of how you do that and how you put it in place needs to be particularly done very well. You would need to make sure that you are dealing with an advisor that understands self-managed superannuation inside out. You would more than likely have another structure in place, such as a unit trust. Could you borrow to purchase a business to invest in through your self-managed super fund? Probably no. There is ways to do it, but I wouldn't recommend it. Look, in simple terminology, to go back to the sole purpose test, the difficulty I have is when a person wants to purchase a business through an SMSF is, are you willing in that business to keep everything commercial? Are you willing to pay yourself a commercial wage? Are you willing to deal into everything commercially and not receive any benefit outside of the normal situation of being an employee? Then it's probably possible. If you go outside of that normal commercial arrangement in a business, which most people do, then you're probably going to fail the future tests of the sole purpose test for the self-managed super fund. So the answer is yes, you can. Do I have any? My answer is no. I do not have a client that's done that. It's just far too difficult from a compliance point of view.
Steve, in answer to your question, Steve already has an SMSF with property in it. So with respect to the poll, I suppose you'd ignore the first half. Do you intend to set up an SMSF to purchase a property? And it's just, do you intend to purchase a property? In your case, that may be no. Another question?
The next question's a really good one, actually. I don't get asked this much by people, but I emphasise it when people are doing such an arrangement. You must borrow to purchase the question is, right, borrowing to purchase an asset in the SMSF must be for a single asset. And I'll emphasise that, and I'll repeat it. To purchase an asset in the SMSF must be for a single asset. So the shares for shares, would this be a single parcel of shares in one company? The answer to that is simply yes. Well said, put the right way. If you are borrowing to purchase shares, it must be for a singular parcel of shares. It doesn't necessarily need to be in a single company. It needs to be a single identifiable group. I don't know when that is, to be honest, not in a singular company, how you make that a singular parcel. I don't know how you could purchase and do it that way. It's not possible to do one trade to buy BHP shares and Commonwealth Bank shares at the same time. But for example, if you bought 1,000 Commonwealth Bank shares, which would cost you $80,000 and you were borrowing $50,000 to do that, then simply yes, that would be done. Can you sell part of those shares? No, they must be sold as a complete asset and the debt must be paid in full. So the full 1,000 Commonwealth Bank shares must be sold complete as 1,000 Commonwealth Bank shares and repay the debt out in full at that point in time. Next question there was, I was given to understand that one should consider the decision of setting up an SMSF as part of an overall financial plan. Would you feel this would be advisable? Absolutely. I think when you define financial plan, there are two levels to financial plan. You as an individual may be very astute and may already have your own plan mapped out and may understand what you want to do. If you have any hesitation as understanding what your financial plan is, you should seek a financial planner that, number one, understands self-managed super funds. You need to be, this is me being a bit cynical of the financial planning industry that I'm also part of. You probably should ask the right questions around the financial planner as to how they feel about property. You need to remember accountants and financial planners like ourselves that are, I won't say pro-property, but I'm definitely not anti-property. And what I mean by that is I think it's a very, very important part of any strategy to have direct property holdings and have them correctly established. But you probably need to ask the financial planner whether that's in their normal thought process. Very, very, very few financial planners receive the commission structure or payment structure they want by a client buying direct property. So you'll find most financial planners will tend to be acting in their own interest. But if you find the right one that can help you establish your plan, then yes, I would suggest you do talk to a planner. Certainly parting, with $1,000 or $2,000 to establish an overall roadmap as to what you want to achieve towards retirement is probably a small cost in the overall strategy. Good question. That's come in with relation. Gee, they're very, very good questions. The question's come in which is in relation to the question about buying a singular parcel of shares and borrowing. The question is, does that mean that you cannot purchase a managed share funds? No, the answer is you can buy a managed share funds. The managed share funds or the units in a managed fund is a single identifiable parcel of unit holdings within that managed fund. So the question is obviously quite astute in this area. A managed fund will have a parcels of shares across maybe hundreds and thousands of shares and properties and international equities and EFTs and all different types of investments. When you buy managed funds, this is a very good lesson on managed funds as a financial planner I often teach. You don't know what the hell you're buying. You're buying into someone else's strategy of what's there, but you're buying units as a unit holder. So you don't actually own anything directly except for the units in that managed fund. So you absolutely can do a limited recourse borrowing arrangement or borrow to purchase into a managed share funds. The questions are coming in very quick. The next one is, if you had a balance of $200,000 in your SMSF, would you recommend purchasing one property with a sizable deposit or up to 4 properties with a bare minimum deposit? If you can get 4 properties with 200 grand deposit, you're buying pretty cheap properties in the middle of nowhere, I'd suggest.
You probably get one property, and subject to how much contribution was going in, you might have somewhere between 50 and 80,000 left over in cash.
The question though, would I recommend you buy 1 property or 4 properties? Again, depends on your financial plan, how astute you are as the investor, that you're you are dealing with this situation where the people like Nick, who is very experienced in finding the correct property portfolio for your particular circumstances, is advising that that's the best strategy for you. Nick and I obviously work together and know each other quite well, but if I didn't agree with the strategy he was developing for you, the first phone call I'd make to him and say, I don't agree with this strategy, and I'm going to be telling the client so. And vice versa, he would definitely do the same to me. So each individual person will have a right strategy, but 4 properties for 200 grand probably just won't happen. I just need to scroll back up the questions here. They're coming in that quick that the screen's going off the end for me.
I haven't found past financial plans very balanced, just a comment.
Yeah, I agree. The comment that came in was just, I haven't found past financial plans very balanced, just a comment. I'm not going to go into it. I think people don't really understand the role of a financial planner. I suppose to put it very simply, if a financial planner, or you think a financial planner is going to help you on a strategy to make you very wealthy, then ask yourself the question, why are they sitting across the table or in front of a computer talking to you, or on a phone talking to you? I myself, if I knew how to make 10 or 12% out of everything, I am a leveraged person. I'd borrow $1 billion and I'd make my margin of $500 million a year, and hasta la vista, simple as that. But financial planners will typically have you on a very conservative and slow boat. That will normally involve trying to be very balanced, but I can't determine what really is balanced. I think investors need to take that on board themselves. A good financial planner will be able to give you a very good strategy, hopefully coupled with a tax strategy and your personal strategy, and fundamentally outline a roadmap as to where you want to get to, and point you in the right direction as to who to talk to and how to do it. There's a question here that says, I missed your comments about the approximate setup cost for an SMSF for borrowing to invest in a property. I believe you mentioned you need a proprietary company and a trust. So if you are establishing a self-managed superannuation fund today with the intention or the purpose to enter into purchasing a property that you're going to borrow for, you would need to establish your self-managed super fund, which is the deed document, and a corporate trustee for that self-managed super fund. You'll find costs out there in the marketplace will range from low-level $1,500 through to $3,000 to establish that. We are $1,500 plus GST, but we have an arrangement with clients that we enter into, new clients, where we will heavily discount the initial upfront costs to contract the client for us to look after the tax returns and financial accounts, not financial planning, tax returns and financial accounts for that client for the next 3 years on our fee scale. You then will need to establish a separate company and a separate bare trust. That typically costs around the $1,000 mark to establish that. And then for each subsequent property, you won't need a new company, you'll just need a bare trust or a new holding trust, which is $390. So look, for a client that just wanted us to establish for them and didn't want an ongoing client relationship, I'd simply say budget just under $3,000 to have your company, or 2 companies, your self-managed super fund and your bare trust established. I like to overcost, not undercost. You'll have change out of $3,000 in that situation.
Just quickly, for the benefit of those who can't hang around, and you're welcome to, keep asking questions. There's some really good questions. I'm going to just reveal the results of the poll. Okay, 15% have said yes, they want to set up an SMSF for the purpose of buying property ASAP. 25% have said yes, but they want to let the turkey and the ham settle after Christmas. 37% are not sure. They've probably got more questions and want to engage in more conversations. And 22% have said no, it's not for them, possibly because they know they don't have enough. Which leads us into the next question that asks, in relation to the too old question, would you say there is an age where you are too young to start, e.g. considering a 25-year property loan, but we're only 25 or 30 years old, so would not be able to access super, blah, blah, blah. I think that comes down to what they've got in their super, doesn't it, rather than age?
Comes down to what you've got in the super. Look, I love this question. I absolutely love it. I mean, look, I'm in my mid-40s. And I wish I had started the process of thinking about, I shouldn't say that. I actually established my own self-managed superannuation fund in 1996. And I'm in my mid-40s, so most of you can do the math. I was the 25 or 26-year-old at that point in time. And I did it off a very minimal balance because I was an accountant that could do my own fund in terms of tax return compliance and all the rest and everything else. And I'll be honest, my intent at that point in time was just to educate myself a little bit into the investing process, using funds that probably didn't matter too much to me at that point in time. But the answer to that question in terms of are you too young rather than too old is, I think for all of us that are listening here tonight, if you're in your 40s and you owned 2 or 3 properties in your superannuation fund and you couldn't access it for another 20, 25 years, financial planning is all about how secure you feel and how comfortable you are. I'd be pretty comfortable that my retirement's going to be okay. So the question is, you're never too young, but as Nick emphasised or said, you definitely would want to have enough balance to make it financially viable. But then again, if you were 25 years of age and you had $10,000, I would happily talk to you and say, well, what's your strategy? What are you trying to achieve? I, of course, would disclaim it and say that you're not financially viable to do it, but if you have a very smart strategy in place or an opportunity, then possibly it's the right decision. Great question. Right, I don't address this very well, so it's a good question. The question is, how are your setup costs paid? By your super or out of your own pocket? So it's a real chicken or the egg. Like most advisors, we don't like to go and do a lot of things that'll be a few $1,000s and not be paid before it's all established and done. But the question is quite simple. If you enter into an arrangement with us that we obviously trust your situation and what you're doing, the funds should be paid by your self-managed super fund. So if you establish your self-managed super fund and pay for it yourself, it'll be deemed as contributions into the superannuation fund. So possibly you can get a tax deduction for it, or it's an initial boost into your super fund for the structure of it. But what we typically do is if the arrangement's quite good with the client, we go, look, if your establishment costs, and I'll go into it if anyone wants further information about it, but typically most of our clients are established into the self-managed super fund and the corporate trustee for $550. There are conditions around that, and that's about the ongoing relationship. But for that $550, we obviously want to enter into a long-term relationship with the client. We just invoice you, but say, look, you don't need to pay it until your funds have been rolled over into your superannuation fund. So really good question. Good question here again, and we do have this situation. Would you use 2 accountants, one for your personal tax return and one for your SMSF, or best to use just one? I guess it would depend on whether the current one is comfortable with SMSF. Yeah, look, it's a great question. We do have a number of clients that we only do the self-managed super fund work for, and they have their other work with their accountant. They've had their work with the accountant for a number of years. The reasoning often around that is, to be honest, we actually have accountants that refer self-managed super fund work to us because it's not their level of expertise of what they do. But some people have been family friends with their accountant or different things for a long time. They know that their accountant knows their relationship and them personally very well. We encourage them to stay there. There is some cross-dependency between your personal tax and your self-managed super fund in terms of developing and determining a strategy, but they're not a necessity. So, you know, there's should be no cost difference between having it all with one accountant. It does, and we do. I mean, it just means that I've got to correspond with other accountants at times to find out exactly what's going on in a person's personal tax return, to whether that matches with their self-managed super fund interests or what they're doing.
Just a reminder, guys, there is a fact sheet that you can download. The link is in the side panel on SMSF and property. So that'll just give you a little bit more information to back up what you've heard tonight. That website that you see there, mrdpartners.com.au/contact-us. If you would go there, leave your details and feedback on tonight's presentation and tell us what steps you'd like to take next and how Brendan and his team and me and my team can assist you. I'm pretty impressed. You guys have asked some really, really good questions, and There's only 2 people that have left the room. One just left. The others have all stayed throughout the whole question and answer time. So it shows that there's a genuine interest and a genuine hunger for you guys to know more. So we're happy to keep talking to you, to keep answering questions. We'll stay for another minute if you've got another question. Greg, my buddy, he's a good guy, Greg. Can you please take the poll screen off? Oh, okay. Thanks, Greg. I did that last time.
Good question, Greg.
I did that last time too. Where is it? There it is. Is that gone now? I think it is. All right. Anyway, you're welcome, Greg. Anyone else with a question? Ask now or forever hold your silence until tomorrow. Brendan, I just want to say thank you for giving up your time, and Meg for coming along and educating it. Oh, here's another one. Apologies, I missed some of your webinar. My questions regarding 200k balance and number of properties was based on borrowing through SMSF, not buying. That's all good. Daniel, thank you. Annette, thank you. Guys, tonight's the first step in the dance. I know most people out there that I talk to really have no concept of what they're sitting on with regards to their superannuation. And let me leave you with this. The biggest plus is that inside an SMSF, you have the ability to leverage. I mean, that's not to detract from the fact that you've got control, you've got transparency, you make the decisions. But in traditional super, no matter how good the return is, it's only a return on your balance. But with SMSF, you can leverage, and leverage is the key. Here's another question. I was held up at work and missed most of the session. Can I listen to a recorded version? What I'll do is I'll give you Brendan's mobile and he can talk to you he'll talk to you in the car on the way home. No, George, that's all good. I have got a recording and we're going to make the recording available to everyone who attended. So I understand what it's like to be held up at work. I'm still in my office. All right, well, thanks, guys. I think that's probably it for tonight. Thanks for your attention, some great questions, and we look forward to chatting with you soon and partnering with you to help you achieve your financial and retirement goals. Good night.